Good morning and welcome to Morning Markets with True Potential. Checking up for big moves and news from yesterday's in the market. Two major news happened yesterday. One is Bank of England raised rates again, and also we saw a sharp market moves in the US markets overall. Starting with Bank of England raised rates by a quarter of percentage points to 1% to the highest level since 2008 in the financial crisis. The move was widely expected, so no big surprises there. But what came as a surprise was Bank of England Governor Bailey said that the bank no longer expects rates to be rising as fast as markets were expecting going into this meeting. Bank of England also indicated that the committee's focus today would be to strike a balance between the inflationary pressure the households are facing to the overall managing growth in the economy. So the key tricky balance for next couple of meetings in a couple of months for Bank of England will be to strike the right balance. The bank also forecasted that inflation will rise to around 10%, double-digit 10% by autumn, but they expect that to ease off in the winter months and well into 2023. Due to these high inflationary pressures, bank also indicated the real households will also suffer from a real income squeeze, which may take some ease of the buying and the demand from the households. And then bank no longer expects the economy to expand in the final 3 months of this year, and that may continue well into 2023. How did market reacted? Overall, the market reacted positively to the news. Bond yields came meaningfully on the announcement, and also equities market rally, as you would expect. However, the pounds came under pressure, and for the first time in this year, the pound closed the day under 124 versus the dollar. Focusing on the other big development in the US equities market, we saw a sharp sell-off in the US equities that started from the bond market actually. US bond market started selling off first, and that spill over into the other risky assets. And on back of that, we also saw a marked weakness in the UK and European equity indices towards the back end of the session. So what all triggered this correction in the US equities markets or US markets overall? It's difficult to pinpoint the exact what triggered this, but overall there is a reassessment from investors of what happened on Wednesday when Federal Governor Chair Jerome Powell indicated that they may not raise as fast as interest rate as fast as markets were expecting. But maybe investors are reassessing that there may be some disconnect between what Fed is delivering message on Wednesday, and what actually Fed may have to do to tame the inflation back in. So what we saw is a marked sell-off in bond market, and then that spill over into every part of the equity market in the US. Started with growth-sensitive sectors like technology, then it spill over to consumer sectors, and also into the wider market. In fact, all 11 sectors in the S&P 500 were down for yesterday, making S&P one of the weakest day for equities in the US yesterday. For the first time also in 3 years, US 10-year bond yields touched a 3% yield mark, so which is another data point we all been observing. So I think it's an important development we need to keep an eye on. How are we assessing these developments? As we have talked with you in the past, selling into these down markets and volatile markets is never a sound strategy, regardless of what is your view on inflation or interest rates or the markets are. In these uncertain times, we always have focused on filtering out the noise from the market and focusing on the actual data. And if we look over the actual data, we expect the data to stay strong, though we recognize that we are coming off at a softer data. But if you look at the household income, the final demand from household or from businesses, that remains strong. The labor market is still buoyant. The earnings picture is still remains very strong. So overall, economic data is still strong, whilst it's softening, but it's not tailing off completely. So that probably that gives us some comfort that there's still room for economy to grow and equities markets and risk assets to continue to grind higher, though it may not be a plain sailing, but we expect towards end of the year equities market and risk markets to be higher from here. What is the focus for today? We get all important US job market data from non-farm payroll. We also get an average hourly earnings. So there are moderate expectations, some weakness in both measures. But if investors will be keenly looking at any weakness or any surprises on upside or downside, so we could probably see some moves on the back of that 2 data points coming out of the US. We will leave it there for now. Thank you very much for watching Money Markets, and we'll look forward to speaking to you next week.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.